So we're going to go ahead and get started. I want to welcome everybody. My name is Elizabeth Aloni, and I'm with Schneps Media. Schneps Media publishes over 70 newspapers, magazines, websites, webinars, podcasts, and events throughout Queens, Brooklyn, the Bronx, Manhattan, Westchester, Long Island, and Philadelphia. We're thrilled today to be able to welcome Jay Mota, financial planner from Prudential Advisors, who's going to discuss about don't leave your money behind and teach us about our retirement options. So without further ado, I will introduce Jay Mota. I want to tell you a little bit about him. He is proudly married with 2 daughters and 2 sons. He was born and raised in the Bronx. After high school, he enlisted with the U.S. Marines and later served the Army National Guard. His career in financial services began in 1997. He studied financial services at NYU and has a degree in business. Athletically, he's run the New York City, Chicago, Boston, and Marine Corps marathons. It's his mission to be a resource and to create value in the lives of others. He's continuously working to improve himself so that he can help as many people as possible in all areas. He's disciplined and governed by his principles. His clients work with him because he takes the time to educate them about planning for their financial needs and concerns, whether it's saving money, getting ready to retire, or discussing insurance. It's his objective to help his clients prepare for whatever may happen in their lives. Ultimately, he works with his clients as a resource to fulfill their needs and expectations. His own agenda is not a part of that. He's committed to his practice. Recently, he was awarded the #1 financial services representative in the country for 2 consecutive years, otherwise always finishing within the top 1 percentile. He's been published as a columnist regarding financial matters, and outside of his professional work, he was nationally recognized for his involvement in the community. The Building Blocks Foundation is a nonprofit that he started that serves the homeless youth attending New York City public schools. Quite an impressive background. It is really my honor to introduce you to Jay Mota. Jay?
Hello and good afternoon, Elizabeth. Thank you very much. I definitely appreciate the warm introduction. So I want to thank everyone for joining this afternoon. Certainly the primary objective is to deliver value and to answer as many questions as I can and cover the topics. This year has been a year that turned us all upside down. My apologies and deepest condolences to anyone who lost anyone. Jobs have been an issue. Money's been an issue. Some people are doing really well and some people are not. Nonetheless, with employers going through this, a lot of people have seen themselves either be laid off, furloughed, or unfortunately let go of. And maybe you just changed jobs because you found a better opportunity during this time period. So what's important to discuss here is that we want to make sure that this is as interactive as possible. If you have questions, throw it in the question box. Ordinarily, when I do these things live, it's very interactive. I understand that this nature is a little bit more difficult to be interactive, but if you have questions, please throw them up in the question and answers box, and I will do my best to address them. And, I'll try to touch on a lot of important facts in a quick amount of time. This by no means is a way to, diagnose or give specific advice to anyone on today's presentation. This is pretty much a general overview. There'll be some good pointers, things to consider, and certainly if you want to have a conversation further about your specific details, we can definitely do that as well. I'll give my number and email later on, but you see it on the screen now. So I'm going to get going here. Let me just see. Oops, of course. All right. So while we start off on this conversation, I want you to think about your retirement. I don't know if we have a poll available, Liz. I don't know how folks can comment to how many people recently are about to retire. I guess if you can throw it up in the question and answer box. Liz, I don't know if you have a chat box. I don't see a chat box.
Absolutely. I'll do it in the chat box so that everyone can see it. And then everyone can feel free to answer right there.
I don't have a chat box, so if you can just let me know. So I just like to ask everyone who's participating, real quick, if you're retiring, just say yes. If you're about to retire within the next 5 years, just say yes. And again, Liz, I don't see a chat box, so if you can just kind of let me know what you see, I'd appreciate it.
I see yes from Ken. I see already retired from Virginia. Phyllis, yes.
Okay.
Another yes, yes,
Okay.
yes.
So many people getting
Yes.
ready to retire. Okay. And if you recently changed jobs and you are either looking for work or you are working somewhere new or have changed jobs in the past, please also just comment with a Y or a yes.
We have yes. Can you repeat that? Someone asked.
Just basically, if you've changed jobs let's say within the past year or throughout this year, for whatever reason, if you changed jobs.
Yes, another yes, a no.
Okay.
No.
All right. So the reason why I ask these questions is because I want to, try to keep my information pertinent to the people who are attending. And I'll say this, for people that are already retiring or already retired, about to retire, there's going to be very important information. For folks that are changing jobs or have changed jobs, there's probably good information in here. And if you haven't changed a job or you're not near retirement, certainly there's information in here that you can take away that you may be able to implement in your current plans that you don't already have. So let's move forward. So think about your retirement. And I don't know why there we go. Okay. So where will your retirement come from? Most of us think about retirement through company-sponsored retirement plans, whether you have a pension or not, Social Security, your individual retirement accounts, IRAs, annuities, savings. Maybe some people are going to supplement their income through part-time jobs, or maybe you own real estate and that's going to be a source of income for you throughout retirement. But retirement income has changed. It used to be that the main source of retirement in the United States was pensions. Now, we're very fortunate in the Northeast. I don't know how many people are here from outside of the Northeast. Every now and then we get visitors from overseas or around the country. But in the Northeast, pensions are pretty popular still, but other places in the country, they're not. And they're dwindling down more and more because they're expensive. The idea of pensions essentially is people are living longer. And the longer people live, the more money that the pensions pay out. And therefore, just like Social Security, they run the risk of running out of money. Interest rates being low, pensions can't get high returns on their money. So therefore, again, it's harder for them to keep pace with the income coming out. So fewer and fewer employers are able to offer them. Social Security, we all know Social Security is a threat. I do believe, and I hope that some form of Social Security will always be around. I know that different legislations have different perspectives on how they're going to keep it afloat, but there's always a risk of Social Security. And it used to be that your responsibility was minimal. And now we see it's flipped upside down. So pensions are very small, Social Security is in the middle, but retirement has really come down onto your responsibility. And if you don't plan appropriately, and even if you have enough money, planning is important. And there are things that are gonna derail your retirement, right? So rising healthcare costs is a big one. Outliving retirement, we'll see in a little bit the timeline of how long people are living. Low interest rates, these rates are supposed to be around till around 2023. With these low interest rates, we're seeing historical lows, due to the COVID and everything that the Fed is doing to try to keep the economy afloat and, banks lending, et cetera. Market volatility, the market has been insanely volatile, very emotional. You have a lot of people who have taken to the market because they saw the dip in March and they bought when they went to buy stock because they thought stock was cheap, and they, buying, your individual investors really increased this year, increasing volatility because there was a lot of emotions involved, and taxes, of course, is always going to be a big part of your income. They say it's not how much you make, it's how much you keep. So we talked about longevity. And the one thing I'll tell you about this slide that's unanimous is women are always going to live longer than men. But if we look at living to age 90, 4 out of 10 men, half the women will live to age 90. To 95, 1 in 7. Women, 1 in 4. And age 100, 3 in 100 men will live to age 100, whereas 7 women out of 100 will live to age 100. So that's a long time. If you think about your working careers, you probably work 30 years of your life, maybe 40 years of your life. I would say most people are in their stride where they're working in their full-time careers. By the time they hit their 30s, they find themselves, and then they work for 30, 35 years, and then they retire. And they retire. If you live to age 100 and you retire normal retirement age, you're almost retired as long as you live. The difference is in retirement, you have to support your income and you have to figure out where that income is going to come from. And that's really how longevity affects retirement. The interest rate paradox, right now we're in very low interest rates. So you're not earning a lot of money. And when you get older or when you're in retirement, interest rates creep up. It affects a lot of income sources that might, that you might be dependent upon. A lot of people rely on bonds, maybe some loans, different things. You can have a contraction in the market due to high interest rates. So right now you're saving at a low interest rate environment, and when you retire, you could be in a high interest rate retirement. So there are different types of retirement accounts. You have company-sponsored plans. I'm sure everybody here is familiar with 401ks. A lot of companies offer them, profit sharing plans, 403bs for nonprofits, governmental entities, 457s, and again, the pensions are your company-sponsored plans. You have individual retirement accounts, IRAs, Roth IRAs, and then again, the Roth IRAs. So there's major differences in all of them, and we're going to touch on them in a little bit, so I don't want to get too much into it on that slide. What are your distribution options? You have lump sum options. You get one payment for the entire amount. You have systematic withdrawals where you can decide that you're going to take installments based upon how much you need to live. And or you can annuitize these accounts and figure out actuarially how long you're going to live based on a factor and then calculate what your payments will last for the rest of your life. And that's typically through an annuity of some sort. We talked about this earlier on. Some other sources of retirement income: savings, certificates of deposits, individual stocks and bonds, mutual funds, annuities, and the ownership of real estate. Just to touch on some of these things, savings accounts, quite honestly, the only reason why you're putting money in savings is for liquidity, right? I mean, in essence, if you put money in a savings account today, you're losing whatever inflation is on an annual basis. So people think their money is safe in a savings account. In reality, you're losing money every single year because the cost of goods go up. And whatever the cost of goods go up, the purpose of investing money is to at least attain the rate of whatever your costs are. So if gasoline goes up, milk goes up, insurance goes up, all of these things that you live on a daily basis go up, you need a way to afford them. And if you have an inflation rate of 2.5% or 3%, whatever factor you want to use, if you're not earning that with your money, well, then you're losing that. And you're losing that on a compounding scale. So just as fast as money grows, you also lose just as much. Certificates of deposits, again, very low interest rates. They have lockout periods, varying time periods. Individual stocks and bonds. Bonds are a good source of income. They offer a guaranteed return of your premium. Sometimes you can make more money than your premium, and there's good strategy with bonds. You have stocks. Stocks are the best way to mitigate inflation. Mutual funds, if you're not familiar with mutual funds is usually a pool of multiple assets like stocks or different types of bonds, and they have different objectives in them. Annuities provide stream of payment. They also provide a life insurance component, which is why only life insurance companies can offer them. Annuities have come a long, long way. I know there's a lot of people that say, oh, don't buy annuities. They're dangerous, they're expensive, etc. And what I'll say to that is that it doesn't apply to everyone. There are good annuities out there and some annuities that provide very good security for folks, as well as liquidity, where annuities in the past maybe didn't provide great liquidity or options for folks. It's really come a long way. And then real estate is probably, one of the better holistic ways of generating income. And again, when we're talking about keeping more money, right, real estate offers also some tax benefits when you own investment properties. So not only can you get income, but you can get some investment related tax benefits from real estate. Obviously, the risk is all the things that are go along with real estate, the maintenance and tenants and, dealing with people paying rent, etc. So it's not the safest, but it's definitely a good way to mitigate. Whoops, let me go back. So let's talk about, this is kind of like the heart of the conversation, right? And I wanted to go through that to kind of get to this point here. When you are, either if you've left an employer or you're leaving an employer, if you're retiring, you have options. And I have to tell you that it's sad because for many years I gave presentations to Con Edison, and a few other large companies would bring me in to help their employees understand how they could retire and their options in retirement. And quite frankly, a lot of these companies offer phenomenal benefits, but they don't do a good job at explaining the benefits and options. And, you get what the herd mentality or the water cooler mentality, where people start talking about what they're doing with their pension or what they're doing with their 401k, and then other people follow along. And, in the years of doing this business, I've never found two clients that were ever the same, who had the exact same situation, exact same needs. And so if you ever heard of people doing the exact same thing, there's a good chance that many people are going to get hurt by doing that. So understanding what your particular options are, what's important to you and based on your needs, and the right thing for you to do is very, very important. You definitely shouldn't do what other people do just for the sake of, them doing it, or someone telling you to do it who's not properly licensed or experienced to give you that advice. But leaving money in the plan, right? So there are pros and cons if you're retiring, leaving money in a plan, and whether or not you're changing employers. I think there's a big difference. However, I would say that, if you're retiring, leaving the money in a plan is one thing. If you are changing jobs and leaving money in the plan is another, right? Because if you're young and you have time to continue to save, it may not be a great idea to leave the money in a prior employer's plan, but if you're retiring, it may be beneficial to you from different aspects. But one thing about leaving money in your employer's plan, if you're no longer employed there, is you can no longer make future contributions to that plan. So that's going to mean that you're going to have to open an additional account. So if you go to, let's say, another employer and they have a 401k, or you decide to open an IRA, now you have to monitor your account in multiple places. And where that becomes challenging is when we talk about asset allocation and diversification. When we're looking at accounts, we want to make sure that our clients are properly diversified and they have allocations in different areas that are going to help them achieve their goals and protect them from different risks that they may be concerned about. Oftentimes people think they're diversified because they have multiple types of investments, or they think they're diversified because they have an account with their employer and then they have an IRA here and they think that's diversification. And even if some investments have different names, they could have different names, and you may think that you're invested in different things, but the underlying securities inside those investments could very well be the same thing, and you can have a lot of overlap. And that just means that if you're not properly diversified, which we'll talk about in a little while, you could run the risk of losing money and affecting your ability to retire in a healthy fashion. So keeping track of multiple accounts is never easy. There are aggregate sites that allow you to do that a little bit easier, but very few people partake in that. So definitely, if you're going to start a new employer, you probably want to think about maybe moving that money out just because it'd be easier to manage. But more importantly, if you're changing employer, you can no longer make future contributions. And if you're retiring, the same. Once you're no longer employed, you definitely cannot make any more contributions to the plan. Expenses, people don't think about expenses when it comes to employer plans. People think that, well, my boss pays for everything, and that's not necessarily true. And I think that's because you don't see the expenses coming out of your paycheck and you're not paying them and you don't see it really affect you, but there are expenses inside the plan. Some employers pay those expenses, some of them cost share those expenses, and some of them don't pay any at all, and the expenses go on to you. So understanding how those expenses may relate to other plans that you have options to is something that needs to be analyzed. Most plans, and when I say plans, I'm talking about your 401k, your 403bs, things of those nature. Pensions, you really have no control over the investment options. That's handled with the pension and the fiduciary of the pension. But when you're dealing with the 401k, You have custodians that hold on to the accounts. Someone's running the 401k and choosing what investment options are in there. Some plans I've seen have a lot of options where you can get a good amount of investment, and you're by design and for protection, they need to have a minimum amount of options to be able to afford you the opportunity to diversify your portfolio. But some of them have a lot and some of them have a little. So the investment options in there may not really be beneficial to you. And again, just because there may be a growth opportunity to grow your money inside of your 401k doesn't necessarily mean that that's the best growth fund out there from an expense standpoint or a management standpoint or a return standpoint. So there are different factors to look into. So limited investment options tend to be a factor when you're talking about leaving money inside of a plan. We had a question early on that talked about, taking money out. So one of the pros to having money and leaving money with your employer is that if you retire or no longer work with an employer after you're 55, then yes, you can get penalty-free distributions, which is unique because all the other retirement accounts require you to be 59 years and older. Now, if you stopped working for that employer at 53 and now you're 56, you can't do that, right? So you had to have been working with the employer till you're older than 55. And if you no longer are working with that employer after 55, then you can take money out without paying the penalty. And the penalty is 10%, as you know, for early distributions, unless you are disabled. And obviously, if you're no longer working for the employer, there are other ways to do it with a fixed amount of withdrawals for a period of time. It's called the 72T. It just gives you a fixed amount of time, but it's not really a great way to go. So definitely if you are, let's say, young 50s and you're changing employers and you're thinking about moving on to someone else and they have a plan and you're able to, that's a big thing. Like some employers allow you to bring over and some employer plans don't allow it. But if you're allowed to bring it over and you're going to retire soon, you may want to consider putting it into a new plan just because you can retain that penalty-free withdrawal after 55 and you're no longer working. But that's only if you leave the plan in or the money in the plan, or if you move it to a new plan and then later you retire. But again, you have to know that you have to work until you're 55 and older to get that benefit. You can't stop working before and reach 55 and expect to get that benefit. And the other thing about the plan benefit is through Irisa, your retirement plan, Irisa was formed back in '74 to protect all employee retirement and investments. You have unlimited protection. So like if someone sues you or you have to file bankruptcy, you have unlimited protection, which may not be the case outside of plans under the Irisa rule. So that's something that you should consider as well. That if you have a large amount of money and you don't want that subjected, then you may want to consider leaving the plan, the money in the plan to protect those assets. There are protections outside of it, but not as great as unlimited. So I think we have a question up here. Let me just see here. Oh, it's been cleared. Never mind. All right. So
I can give you the question.
Yeah.
Is there anything we can do from Sophia? Anything we can do if we feel like the employer's plan doesn't provide the best growth?
So the question I ask is, are you still working there?
Sophia, can you tell us that? If you're still working there.
So, I mean, until she answers, I'll just say for the sake of time, right? There's always something you can do. She answered yes?
Someone else said yes, I was laid off. So it's
Oh yeah, Sophia said, yep, okay. So here's the thing. Laid off, never going back. Do you think you're gonna go back? That's something you have to think of. But people often ask me, well, should I pay money to my 401k or should I do something on my own? And what I'll always ask is how much you plan on contributing, number one. Number two is, does your employer do any kind of match? So that's free money, right? So most employers have some sort of match. That's just free money. And if you don't take free money, call me and I'll take free money. But if your employer is giving you any kind of match, you want to at least contribute up to the match. I mean, that just seems to me to be obvious. But if there is no match, well, then there's a second consideration, because you can contribute up to over $19,000 depending on your age, and $6,000 more, 19,500, and an additional 6,000 if you're over 50 into your employer plan. Now, your individual account, you can do 6 or 7 depending on if you're over 6,000, if you're under 57, if you're over 50, to do catch up. But so if you're a person that's looking to max out their savings, then the best way to do it is through your employer. But if you're not looking to max out more than 6%, then you may want to consider doing an individual retirement account. However, there's something to know. There's always caveats, but there are income thresholds for deductibility for contributions to your own plan. So this is why it gets to individual recommendations, because we have to look at your income, adjusted gross income, whether you or your spouse are covered through an employer. And if you are, how much of that can be deducted? Do you have any deductions, and what else you may be qualified for? So, but more specifically to the question, can you do anything about the growth fund? No, you can't. You're stuck to, and that is the problem with employer-based plans, is that the investment options are selected for you, and you have to kind of sometimes fit a square peg in a round hole. Most employers give target date funds. Those tend to do better, which means that you pick a fund like a 2050 fund or a 2030 fund. It just depends on what year you want to retire, and then the money gets allocated in different levels of risk based upon when you want to retire. So as you get nearer to retire, the money gets to more conservative type of investments, et cetera. And those usually do pretty well. They cost a little bit more because of the management involved, but they generally do pretty well. So, I mean, what I would say is, Sophia, is, it's definitely worthy of looking at your particular situation to decide whether or not you have alternatives. But that's the best answer that I can give here in a general conversation. And I hope that was helpful to you and anybody else that was curious about that. But great question. I appreciate you asking that. So back to rolling money over to a new employer, okay? So if you start a new job and they have a plan, you can ask them, or should ask them, hey, I have a 401k in my old employer, can I move it to here? And then you can make a contribution. And so what's the benefits to doing that, right? Well, number one, the money never touches your hand. It goes trustee to trustee, and you don't pay any penalties or any taxes. The money will continue to grow on a tax advantage basis, whether you are contributing after tax or before tax. It's a 401k or a 401k Roth. However you were contributing, you may be able to contribute to that. Be careful though, because if you're contributing to a 401k and or a 401k Roth previously, your new employer may or may not have a 401k Roth that you can contribute to roll it into. And you definitely don't want to take pre-tax money or after-tax money and putting into a pre-tax account. So something to consider there, but definitely advantageous to move it over if you can. And some reasons why, right? So if you have individual accounts, you're normally not allowed to take any kind of loans or anything out. There are qualified withdrawals and distributions that you can take out through individual retirement accounts. But for the most part, if you need money in a hurry, IRAs and things like that, you don't want to touch. But if you need money in an emergency, you do have the possibility of getting loans out of your 401k. And generally speaking, they were 50,000, depending on how much you have, or 50%, whichever was greater. And now, and it also depends on how long you've been working there, but they have limits set on how much you can take out as loans. The CARES Act has increased that to 100,000. So you have a significant amount of money that you have available to you if you need it, and you can borrow money from your plan versus withdrawing money from the plan, and you can have a repayment structure right from your paycheck. So it is beneficial. You have hardship loans, you have general loans, and you also have, loans to take out to buy a home. Keep in mind that loan provisions and all these kind of rules, 401ks are set by the employer. And when I do 401k plans for businesses, it really is up to the employer. All the decisions are up to the employer. Will they allow this? Do they allow that? How long will it take to vest? What type of match you're going to do? Who's going to pay the expenses? All of these things are determined by the employer. Chances are, the smaller the employer, the fewer benefits you're really going to get with it, because it's expensive. The larger the employer, generally you get more benefits, just in my experience. That's not a rule. So, and if you have a loan existing, one benefit is, like, it used to be if you leave an employer, you had 60 days to get the money into the old plan and pay back the loan, or else you were going to get dinged for income. The CARES Act has extended that up until the filing date. And if you filed an extension, you have up until October. But, if you have a loan existing, you may be able to bring that loan carried forward, and it's mirrored into the new 401k plan, so you can continue to make payments back to it, and you're not going to suffer any penalties and or taxes. So that could be an additional benefit to rolling over to a new employer.
Jay, we had a question come in.
Okay.
If that's okay for me to share it with you now.
Yeah, please.
Someone asked, I inherited from my deceased spouse a 401k, and I'm sorry for your loss. It's grown, but not sure if I can contribute.
No.
Is this usually the case?
Yeah. No. So
no, you cannot contribute.
You cannot contribute to your spouse's 401k, and so plans generally, if you have less than $5,000 in it, they usually require you to take it out. Otherwise, they keep the money in there. But what I would say is there are ways that you can utilize that money. I don't necessarily know if leaving it in the 401k is the right thing to do. One thing I will say about 401ks, and again, this is not to tell you that they're all bad or they're all good, because again, it really depends on individual cases. But it sounds like to me, immediately what comes to my mind for the person that asked that question, and I too am very sorry for your loss, is that are you really getting what you need to get from that plan? Because there are a lot of limitations, and limitations as far as investment options, and limitations as far as, just general service, excuse me. So, understanding what your needs are, whether you know what your needs are, if you sat down and actually done an analysis based on your needs, now and in the future, and what kind of returns you need to get, and how much risk are you comfortable taking, how long does the money have to last you, how much income do you need from that money, what kind of withdrawal rate can you sustain. All of those things is what a financial professional will do for you. A financial advisor or someone like myself as a financial planner, that's what we do for our clients. And so leaving it in the plan is kind of just like, hey, it's there, Again, I'm not saying that the people at the HR department are not great people and they're not wanting to help you. They are, but they're not really qualified. And even if they're licensed, licensing just means that, you're able to do something. I mean, we all know a lot of people have driver's licenses. Doesn't mean that everybody's a good driver. So it's really important to sit down and look at all of your options there, because you do have a special, there are special provisions for you when that happens. And you're not subject to penalties as such for taking any early distributions or anything like that. There are options out there for you, and that's something we would have to talk on an individual basis about. But great question. But no, you cannot contribute to a plan that belong to your spouse, whether they're with us or no longer with us. A spouse can't contribute to the other spouse's plan. It's just not possible. You have to be an employee, and there's certain requirements being an employee for eligibility purposes to be able to contribute to the plan. So you would have to roll that into an IRA or take it as an inherited IRA, which I would recommend an inherited IRA. But again, we can talk about that more on a personal level. But thank you very much for asking the question and sharing your personal story. And again, my apologies and condolences for your loss. Getting to rolling over into an IRA. So there are different types of IRAs. There are implications for tax, both on the front and back. There are contribution limits. There are, deductibility income phase outs, which means that, if you make too much money, you may not be able to deduct. For Roth IRAs, if you make too much money, you may not be able to contribute, so that's why it's also important to look at, how much do you want to contribute? How much income do you make? And really determining. There are people who work and have 401ks and they have IRAs. They maybe contribute up to the match at their employer, but they're really not fond of the plan. So they contribute up to the match at the employer and they make their outside contributions to the IRA or a Roth IRA or whatever, type of plan they want to set up. But certainly that's, again, it's all a part of management. The important part about rolling over into an IRA, and if you start another plan, remember diversification is key. When it comes to investing, handling risk, handling any kind of market volatility, diversifying your portfolio based on the assets and what they are invested in, not necessarily the name, because again, as I mentioned earlier, a lot of investments have different names, but could be the same exact investment. You may not know, unless you're buying individual stocks, then you know they're not the same. But most people invest in mutual funds and retirement account to further handle diversification and handle the volatility. But when you're rolling over into an IRA, as I just mentioned, provides versatility and flexibility. You have the option usually of thousands of investments you can put into an individual retirement account. I mean, you can hold a lot of things into an individual retirement account, whether it be a Roth IRA or a traditional IRA. The reality is that that just really handles how the tax is handled and how they look at your income. But the investments, you know, you have a countless amount of investments to choose from. You own your account. So, you know, there's no one that can tell you what to do. You can pick that account up and take it to whoever you want to help you manage those funds. But it's yours. You can do whatever you want. You have access to your money. May not be the wisest thing to do, but listen, if I need money, I have access. I don't have to go through an employer. You know, if you have a plan with an employer and loans are not available, or, you know, you've maxed out loans or whatever the case may be, or they don't allow general loans, they only give you in hardship. Again, the plan is ruled by the employer. And you need money and you still work there, you have no access to that money, right? Because that's, you know, the good and the bad. But with an IRA, no one can say no to you, right? They're going to say, listen, you're going to have tax and penalties, but no one can say no to you. So you have access to your money. Your assets continue to grow in a tax advantaged way. Again, depending on what type of account you have. Even though you're rolling it over to an IRA, you still carry forward tax advantages. And you know, there are penalty-free distributions. You can even get tax-free distributions from like a Roth IRA, provided you meet certain conditions. But you do have opportunities to use money. Some people use money for education. They have medical expenses. You know, there are certain reasons why you can withdraw money from an IRA. So it's not like it's, you know, put in there and you don't have access to it. But again, knowing that all of that pertaining to you is very important. And the least recommended option is cashing out, right? So I've seen it happen on many of occasions where people retire and they want to cash out lump sum, you know, and it's sad because there are some people who have never had $300,000 or $250,000 or $500,000 in you know, in their bank account at any given time. So you know, it changes you and you think that the money's going to last forever, but it goes quick. So taking it out full is not a great idea. If you cash out early, you have penalty and mandatory 20% withholdings, and it can be extremely damaging to your financial future. And again, you know, creating a personal retirement strategy, I've done these before and I say it all the time. If you don't know where you're going, you have no idea how you're going to get there. So if you don't know what your needs are in retirement and how long and planning for that, you know, what are you really saving for and towards? You really have to take a look at it. We talked about diversifying your assets. Diversification, you know, whether it be different types of investments, different sectors in the market, you know, you really want to diversify your portfolio to help you protect against volatility and risks. So account withdrawals, you have taxable, tax deferred, and tax-free, right? So there are different types of ways to retiring and taking money out of your accounts. Sources of income that may be taxable, okay? Now you have certificates of deposits, you earn interest, you get paid tax on it. Stocks, you have any capital gains, short-term, long-term capital gains. Dividends are paid out. You have mutual funds, the same thing. Bonds, the dividends and the money you earn in bonds could be taxable now. Taxable later, pensions, IRAs, annuities, 401ks, 403bs, and other sponsored plans. Social Security could be taxable. You can pay up to 85% up to 85% of your Social Security check could be taxed, based upon what your modified adjusted gross income is in retirement. Things that are likely never taxed: municipal bond interest. Those are bonds issued by municipalities. Life insurance, death benefits, Roth IRAs, 401ks, and 403bs, and HSAs that are used for medical expenses. So understanding what type of accounts you have is also a part of diversification, because when you retire, you have to know, well, what am I going to be taxed on and how am I going to be taxed on it? And again, it's not what you make, it's what you keep. People often think to themselves, well, taxes are low. I pay very low taxes right now. And the reality is, back in the 70s, we had upwards of over 90% income tax, right? There were 26 different, what do you call it, classifications. Right now, there's only 6, and 37 and a half is about the highest right now. And that's just federal, not including state. If you live in New York, you're paying high taxes. If you live in New York City, you're paying even higher taxes. You know, if you live in New York City and you make a lot of money, you could be paying almost 50% of your check to Uncle Sam. But the taxes change. And we see where the lowest have been and the highest have been. But the moral of the story is that you can't plan today for what you're going to get specifically in 20 years. It's impossible. You just don't know. You can, strategize and plan for the worst, but, being tax adverse and planning and considering taxation is just as important in any plan as, where you're going to live. It's just that important. So managing when and how you're taxed. We talked about being taxed now, right? Tax you now. Investments, annuities, CDs, money market accounts, real estate. Those are all things that you're getting taxed on now. Qualified, you invest, tax me later. Your 401k, your IRA, your SEPs, your tax sheltered annuities, 457s. You're paying into it now. You're not paying tax, and you're going to pay tax later. And guess what? The reason why the 401k and all that started back in the 70s was because conceivably people were paying much higher tax brackets back in the 70s, right? So imagine if you were in one of the 26 different brackets and you were at the 65 percentile of taxation back then. And you said to yourself, well, if I defer taxes today, my taxes are going to come way down, because when I retire, I'll make a lot more income. Well, you're deferring taxes at a higher income to pay a lower bracket. Well, what we've seen is, where taxes are going to go. We're at a very all-time low of taxation. And if you're working now and you've got 20 years, 10 years, 15 years to retirement, even if you're going to retire in 5 years, you can live 30, right? Where are taxes going to go? So if your income is subjected to taxes in retirement, you could be deferring taxes today to be facing a very high tax bracket in the future. Does that make sense? It doesn't. So this is why you have to diversify your investments also to help you plan for those taxes. And then tax again, don't tax me again. Again, municipal bonds, life insurance, and Roth accounts are all, you pay your tax now, you're done. Whatever it grows to, it grows. It's your money, happy day. Again, balancing your accounts to have control and knowing what type of income you can truly expect. Because if you have a Roth 401k or a Roth IRA, guess what? You're never going to pay tax on that money when you retire. So it doesn't matter what taxes do. Your money is your money. And that's the beauty of having it. Question is, can you qualify for it? So that wraps up our presentation for today on retirement accounts, taxation. We talked a little bit about diversification. I wanted to leave enough time for questions and answers, because I know there's a lot of information in there. So I wanted to leave some time for your questions. So please feel free to type in your questions. Love to answer it. And if you have any questions on anything, it doesn't necessarily have to be on this, anything to do financial related, I can address that as well. So whether it be insurance or investment accounts, retirement accounts, tax, whatever your questions are. So please feel free to shoot your questions into the box.
We have our first question.
Okay.
Actually, we have 2 that just came up.
Okay.
Phyllis wants to know, she wants to retire ASAP.
Mm-hmm.
And she wants to know, can I take from pension and her 401k before applying for Social Security?
Well, let's look at it. So Social Security, unless you're disabled, you have to be 62, right? I don't know what your full retirement age is, whether it's 66 or 67, but Social Security starts at 62. Unless you're legally disabled, then you can file for Social Security disability. Your pension and your 401k. So your pension really depends on your employer and what their rules are. Generally, you can take it out early from a pension if you retire with a certain amount of credits or time period served, and that's something that your employer would have to tell you. Your 401k, again, if you're over 55, you can take money out without penalty from your 401k. And you would pay taxes on whatever you took out, but there'd be no penalty if you're older than 55 and you're no longer working from that employer. So yes, you can. Social Security, you have to wait till you're 62, and Medicare is 65 by default. But that changes if you're disabled, because then you have Social Security early, and you have Medicaid that you would apply for in lieu of waiting for Medicare to kick in.
Great, thank you.
Mm-hmm.
Good Thing had a question about the fluctuations of the stock market and wanted to know if you could touch on what may happen if the elections go one way or the other, that he's getting recommendations that if one president gets into the office, we should take all our money. And he said it sounds very scary. So what can you speak to this?
So I want to ask you how, if you would share your age and what are you saving for? Well, let me just,
I can jump to the next question if you want while we wait for the response.
I'll answer it. So here's the answer. Here's the answer. Number one, there are no crystal balls, right? So like, if you would have asked me, if you listened to every expert back in April when the market crashed March 24th, the onset of this COVID, when it really got, hot and heavy, no one expected the market to rebound the way it did. We were just having a conversation, Liz and I, about, real estate they sold over 1 million homes in August, and that hasn't seen those numbers since 2006. And we're in the midst of a pandemic. Builders can't keep up with demand. And they're afraid to keep building because they don't know how long this demand is going to go. So everything they say that's going to happen negative has actually been extremely positive, which is an anomaly, right? Because you would think that people are losing work, the government is spending money. You would think all of the bad things are going to happen, and they haven't happened. So the answer to your question is that you just don't know what's going to happen, and there is no way to predict what's going to happen, because if they did, everybody would be rich. And the reality is, you either believe that you can manipulate the market based upon factors like that, and you can invest around it and diversify around it, or you just believe that markets are efficient and they're going to continue to do what they do regardless of outside circumstances. And that's kind of like what we're seeing. However, what I will say is, what's most important is that, you got to know what you're investing for. Are you investing for retirement and you're going to retire in 20 years? If that's the case, then don't even listen to it, because it doesn't matter. You're going to see a lot of ups and downs. A lot of things are going to happen over the next 20 years. You got to stay the course. There's an expression that I heard a long time ago, and I really like it. You can't catch a falling knife. If you try to time the market, you're going to sadly be mistaken. So understand what your objective is. And this is the true answer to your question. You have to first look at what your investment objectives are and what you're trying to achieve. And then you should always review potential risk to your portfolio and how that's going to affect the overall plan. But again, earlier, as I said, the water cooler or the herd mentality, what people say, you can't jump on board and say, well, I'm going to do that too, because guess what? When we were kids, you used to say, well, if your friend's going to jump off a bridge, would you follow them? And the reality is that you really got to look at your particular situation. So, there's always going to be commentators about, Biden gets elected versus Trump and et cetera, and this is going to happen and that's going to happen and this is the agenda. These two guys, whoever is going to end up in office, however much control they have, believe it or not, there's a lot of, people beneath them making decisions that affect the economy a lot differently than just them. So I would say that you really have to look at your individual situation. Don't listen to the herd. Don't move with the herd. Take control of your own finances and look at your particular situation, and then discuss, well, if this happens, how will it affect my portfolio? If this happens, how will it affect my portfolio, and whether or not there's a reason to make any changes? So that's the answer to that question. Thank you for asking it, by the way.
Great advice, Gary. Gary, I'm saying Jay, because Gary is our next question. How can my personal bank IRA be pre-tax?
Personal bank IRA be pre-tax? Well, let's just say, so an IRA is an individual retirement account that you may have obtained through your bank. Chances are the bank is just providing servicing on it. The custodian is probably through somebody else. However, the Roth IRA is the one way that you could contribute after tax and then get, the money grows tax deferred, and you could pull the money out entirely tax-free to include any growth once you retire. You also have access to your contributions at any time. So Roth IRA does provide more flexibility. The traditional IRA is a before tax. And if that was your question, what happens is you get a credit on your tax return. So they deduct that from your income. I apologize. It's not a credit. It's a deduction. What happens is, when let's say you make $100,000 and you contribute $6,000. So right off above the line, right there, they're going to deduct, okay, well, he made $6,000 contribution. So his taxable income is now 94. And then you have other deductions that you can, apply to reduce your, what they call adjusted gross income, which is what they utilize to apply whatever tax rate you're going to pay. So your bank doesn't do anything with taxes. Your bank just takes the money from you and deposits in an account, make sure that the securities are purchased. And then at the end of the year, they're going to give you a 1099-I, and that's going to show how much you contributed to the plan in the year that you contributed for, and your accountant should know where to deduct that from your income so you don't pay tax on that money. You've already paid tax on it, but you're going to get it back when you file your taxes. You're not going to get the money you paid. You're just going to get they're going to deduct your income so you'll owe less money at the end of the year. You either get a refund or owe less.
Great. Christine asks, the 401, 403 withdrawal due to COVID-19 of up to $100,000. Do you have to prove that it's for an emergency use, and is it penalty free?
So it's penalty free. However, it is employer specific. It's not something that employers have to do. It's just like right now, there's a lot of gray area with the Social Security tax and whether or not employees have to pay Social Security tax. I'm an employer and I am not allowing employees to not pay into Social Security because they have to pay it back in January. So it's really, be careful what you read. It's not all what it's up to be. So taking the money out of the 401k via COVID is an employer specific situation. The government basically said that they're not going to implicate the 10% penalties if people take it out. They also increased it from from 50,000 up to 100,000. But again, your employer has the final say on how they're handling that. The government just gave them the opportunity to do it. It's up to the employer to actually implement it.
Good to know. Thank you. Rhonda would like to know, when you're older than 59 and a half, can you take money out of the 401k from a former employer without penalty, even if you're currently working for a different company?
Yeah, good question. So yes, you can. Yeah.
Great. Yeah. Sophia has another question. She's been doing research.
Liz, I'm sorry. I just want to go back to the previous question.
Absolutely.
I got to tell you, you really should, I think it was Rhonda, you really should consider that money at the former employer and why you're keeping it there. I will say that I'm a little bit biased because I'm not a big fan of it, but it may be the right thing to do. It may not be the right thing to do, but to answer your question, you can once you're 59 and a half, but you should really consider all of your income sources and where they're coming from, and if you should tidy it up and consolidate. But I thank you. I'm sorry, Liz.
Oh, not at all. Thank you for the clarification. Sophia wants to know, she's been doing research on the best way to start saving for her 4-year-old, not just for college, but money he can use for anything. As far as taxes, what'll be my best options? And she said a webinar will be great for this subject.
Yeah. So, Liz, you've heard me talk about this before, right? When it comes to saving for children, I have 4. 3 who are adults and working and college graduated, and I have a younger daughter who is in school. So what I'll say is the airplane theory. If you ever got on an airplane, I know many of us haven't flown in a very long time, but when you get on an airplane, the stewardess always would say, or the flight attendant used to always say, put your mask on first before putting it on the minors. The reason is if you don't take care of yourself first, you're not going to be able to take care of the minor anyway. So you got to look out for yourself first. So when it comes to saving for minors, the first and foremost thing that I always ask my clients is, let's look at your financial plan and what you're achieving for your goals and how you're protecting yourself. Do you have all your checks and balances? Do you have a proper emergency fund? Are you saving for retirement? Do you have, are you meeting the needs that you need to make for yourself before we start worrying about the child? Now, as far as saving for the children, it's tricky because you see there's a thing called kiddie tax and it's very expensive. And the government understands that people may try to put money into their kids' names to avoid paying tax on it themselves. So, the kids can get so much money. You also got to look at what the purpose is. If it's for education, some educational accounts make it the asset of the child. That would affect their ability to get educational assistance in the future. Some keep it as assets of the parent. There are different ways. It just depends on what the money is going to be used for. And again, those are one of those things that we really got to narrow it down to your specific needs before I can give an answer. But, you know, financial literacy for children, I'm all about that. I do a lot of education with the schools in New York City regarding this, and some colleges I speak with. But yeah, financial literacy for children is great. I do have a program for it. Maybe we can look into it, but yeah, there are a lot of ways to save. You have multiple, you know, educational accounts. You have different types of trust and things of that can be set up for children. It just depends on what your goals are specifically. But thank you for asking the question.
Great, thank you. And I did just share again Jay's contact information in the chat function as well. We have time for a couple more, Jay?
Absolutely.
Fantastic. So Virginia said, I retired last year at 63. My husband's pension is sufficient for our needs. I don't think I'll collect Social Security or draw on my pension at 65, which is next year. Is it advisable to leave it till much later?
Leave the Social Security or leave your husband's retirement account. I'm not sure what it is, but that's, you know, it's a great, you know, when we look at retirement, so first and foremost, you know, there are different type of expenditures, right? So you have your fixed expenses, your variable expenses, you have your, you know, the discretionary, non-discretionary. This is what I need to spend every single month, no matter what, right? You have to pay your rent, you have to pay your mortgage, your insurance, healthcare, things of that nature, food, utilities. Those things have to be paid every single month regardless. So we always try to accomplish that when we look at a retirement plan. We want to accomplish that based on fixed income. So we want to generate a guaranteed income or a fixed income source to cover those needs. Now, the variable expenses are where we take from the variable income sources. So I don't know what your lifestyle is like and what you want your lifestyle to be. Maybe you want to buy a second home. I mean, there's a couple of factors to look at here. I mean, number one is, you say you're covering your expenses, you know, how long do you plan on living? Do you have a legacy you want to leave behind? Who's going to, you know, get the benefit if you pass away? If you have children, do you want to leave money to them? You know, so it's really hard to answer that question without having specific information. But what I would say is that you got to sit down and look at, okay, where am I today? What are my needs today? And what are my needs going to be in the future? Because there's a lot of factors or pitfalls you may not be considering, like rising inflation, rising taxes, healthcare. You know, healthcare can be very detrimental. So again, I don't know if those things apply to you, but certainly it's worth to sit down and do a review of your situation now and what you want your situation to be in the future and when you want the situation to be when you're no longer with us and how you want those assets handled.
Great, thank you so much. So Mike had a question. Would opening a backdoor Roth IRA be a good idea if my income is too high to open a Roth IRA the regular way?
Well, I mean, again, that all depends on whatever else is available to you. I mean, the backdoor Roth is a strategy. So I can't advise on whether you should do it or not in a public forum like this. And also it'd be ill-advised because there's too much information I don't know. I appreciate you asking the question. And again, it is a strategy for persons in your situation, but, you know, are you self-employed? Do you work for an employer? You know, does your wife work? Is she covered through a plan? So, I mean, there's, you know, things there. I mean, maybe there's ways that you could lower your adjusted gross income that you would be able to qualify. So, you know, it's so hard to answer your question and I want to answer it, but, you know, obviously if I do, I might as well be putting my foot in my mouth because I don't know nearly enough to give you an answer to that question at this time. But I'd love to have a conversation with you. And if you're working with somebody, you can speak with them, but you're always welcome to call me or email me and we can have a personal conversation regarding that question.
Certainly one of the things that we see with all of your answers, Jay, is that, you know, you've given such valuable information today, but also everything is so specific to the individual. And it's so important to really dig into that individual's future plans, et cetera. So we have time for one more question. And that comes from Gary, who is asking about HSA accounts, wanting to know if it's better to use them for medical expenses or if there's an option to invest it in the market to do that.
Yeah, so again, age is a factor, access to resources is a factor, you know, whether you're a healthy person, you know, what does your deductible look like on your medical insurance? There's so many factors to that. The HSAs provide you, tax-free withdrawals. They're a little bit more restrictive. But, the other thing is you have to ask yourself, when you're filing your taxes, and again, this is not specific, to you, Gary, but in general, your deductions for medical, the standard deduction is so high these days that very few people do any itemized deductions anymore. And medical is still one of those things you can deduct for, but you have to spend a lot more money in medical expenses than your income, a percentage, 7.5%, in order to even achieve the eligibility for deduction. But then all of your deductions have to exceed your standard deduction. So if you have a very high medical expense and you're not able to take the deduction, well, the only other way to really get a tax benefit to pay these things is contributing to an HSA. So if but again, are you a sickly person that you see the doctor a lot? If you're not, as an HSA, the right thing to do. If you're not a sickly person, maybe we got to look at your health insurance plan and see how much you're paying for health insurance, and are there other ways that you can cover medical expenses in a more favorable way? But certainly, mutual funds or stocks or anything like that in a brokerage account, you're going to have immediate tax implications. You have market volatility, you have liquidity issues, right? If you buy something in the stock market today, you can't turn around and sell it tomorrow. And if you put $1,000 in the market, there's no guarantee it's going to be worth $1,000. So if you need the $1,000, it may not even be there for you to use. So, I think when you're talking about healthcare, you want to make it a little bit more, if you're worried about healthcare and you're considering an HSA, there's a reason for it. And you probably want to have a little bit more security in that account to make sure that the money is going to be there when you need it. And why not get the tax benefit to boot, right? So again, it really just depends on your individual needs. But that's as general as I can give as an answer for you to consider at least maybe some alternatives, or, I hope I answered your question as best as I could without being specific.
Fantastic, Jay. Wow, this is really, thank you so much for your generosity of all of this incredible information, incredibly helpful and a great starting point. I wanted to let all of the attendees know that they will get an email tomorrow with all of your contact information there, as well as it being posted right now in the chat. And Jay, thank you for being here. As always, your information is so valuable. Thank you so much to our attendees for joining us this afternoon. I hope that you got a lot out of it. I know I'm seeing a lot of thank yous coming through the chat and the Q&A. And we do hope that you will join us on our future Schneps Media webinars. Please note that you will be able to see this again. We are recording it and it will be available on the Schneps Media YouTube channel. So you can see it and share it with friends who you think will benefit from it as well. And just all please stay safe, stay healthy. And thank you for joining us. Bye-bye.
Thank you, everyone. Thank you, everyone, for joining. Take care and be safe.
Thanks, Jay.
Bye.
Bye.